All right, let's get right into it. The Bank of Montreal, or BMO, just kicked off their year, and wow, the first quarter results are in. So today we're going to break down their Q1 2026 earnings report and figure out what this strong start really means for the year ahead.
So what's the headline here? The big takeaway right off the bat? BMO had what its own CEO called a very strong start to the year. And, they didn't just meet expectations, they blew past them. It really sets a positive tone for the rest of 2026.
Okay, let's look at the numbers because this is where it gets really interesting. You can see just how clear that beat was. We're talking adjusted earnings per share of $3.48 Canadian. That's a full 16 cents higher than what the experts predicted. And then you look at revenue, they pulled in 7.21 billion US dollars. That's almost $500 million more than expected. Just wow. And this next number, this one is so important. BMO hit a record 4.1 billion Canadian dollars in what's called pre-provision pre-tax earnings. Now, what does that mean? Well, think of it like the bank's raw core profit, from its day-to-day operations, before they deal with taxes or set money aside for loans that might not get paid back. Hitting a record here, it's a huge sign that the fundamental business is just firing on all cylinders.
All right, so the headline numbers look great, but let's go a little deeper. What are the key metrics really telling us? It's time to get into the nitty-gritty numbers that show the true health and efficiency of the bank.
Okay, first up is a big one, return on equity, or ROE. You can think of this as a vital sign for any bank. It basically answers one simple question. How good is the company at using investors' money to actually make a profit? The higher the number, the better the performance. It's a metric that, believe me, investors are watching like a hawk. And just look at this chart. It shows you BMO's progress perfectly. Their adjusted ROE jumped from 11.3% all the way to 12.4% compared to last year. I mean, you can see it right there. That's a really significant improvement. It's a crystal clear sign of growing momentum in their profitability. At the same time, BMO is keeping a really solid financial cushion. Their CET1 ratio, now that's just a fancy term for a key measure of a bank's strength, its ability to handle tough times, is sitting at a very strong 13.1%. That's well above their target. And what's really impressive here, they kept it that strong even while buying back 6 million of their own shares this quarter. That takes discipline.
So the big question is, how did they do it? How did they pull this off? Well, let's pop the hood and take a look at the engine room to see how all the different parts of BMO's business made this happen.
It's kind of like a tale of two markets. In their two biggest arenas, the US and Canada, BMO is running two totally different playbooks. Down in the US, it's all been about optimization, trimming the fat, getting rid of less profitable loans. And that's about 90% done. Now they're getting ready for loan growth later in the year. Meanwhile, back in Canada, it's a completely different story. One of just steady, consistent growth in deposits and checking accounts. Both strategies are working. And here's the crucial point. This wasn't a one-trick pony. Not at all. The success was totally broad-based. Capital markets, they had a very strong quarter. Wealth management, their income jumped 16%. And get this, every single part of their business reported record revenue. That's just a fantastic sign of a healthy, diversified company. But, it's not all sunshine and rainbows. No business operates in a vacuum, right? The economy is throwing some real challenges out there. And to their credit, BMO's leadership was very upfront about the risks they're keeping a close eye on.
So that leads to the big question, doesn't it? What are these challenges? What headwinds are on the horizon?
Well, the bank's chief risk officer talked about these pockets of consumer stress. And honestly, that's not a huge surprise, given the high interest rates we've all been dealing with. We're seeing some people fall behind on payments in certain areas, especially around the Greater Toronto area. And sadly, credit card losses are up for lower-income folks. It all points to the Canadian economy just running a bit cooler than the US at the moment. And this is exactly where something called the Provision for Credit Losses, or PCL, comes into play. Think of it like a bank's rainy day fund. It's the money they proactively put aside just in case some of their loans go bad. It's a direct reflection of how much risk they think is out there. But here's the interesting part. Even with those consumer pressures we just talked about, BMO's rainy day funds, their PCL, actually declined this quarter, down to 746 million Canadian. So what does that tell us? It tells us that, yeah, the risks are real, but the bank feels like they've got a good handle on them.
They feel they're well managed, keeping everything stable and predictable.
Okay, so we've got a strong quarter in the books, and it looks like the risks are under control. So where does BMO go from here? What's their path forward? Let's take a look at the long-term strategy. You can hear the confidence from the top. CEO Darrell White said it pretty plainly. He has strong conviction that the bank can hit its super ambitious goal of a 15% return on equity by the end of 2027. And that's not just some target they throw out there. It's a real multi-year commitment. And this timeline right here, it proves they're not just talking the talk, they are walking the walk. I mean, after a best-in-class improvement last year, their underlying ROE is already up to 13.1%. You can literally see them making real, tangible progress on this journey, quarter after quarter.
So how are they going to get there? Well, a huge part of the plan is technology. BMO is going all in on a digital-first, AI-powered strategy across the entire bank. For example, they've already rolled out a generative AI assistant for their own teams. It's a perfect example of using today's tech to make things more efficient and ultimately better for customers.
So, let's wrap this up. What's the bottom line? BMO delivered an absolutely powerful first quarter. It was driven by really strong execution across the board in all their businesses. At the same time, they're managing their risks, they're investing in the future with technology, and they have a laser focus on their long-term plan to boost returns for shareholders. And that leaves us with one final thought to chew on. BMO clearly has the strategy, and they definitely have the momentum. But the big question is this. In this uncertain economy we're all in, can they really navigate all the headwinds out there to hit that incredibly ambitious 15% return target? We'll have to wait and see.